If you look at the stock market today, especially over the past few years and really accelerating recently, you'd think the economy was just completely invincible.
Oh, absolutely. I
Yeah.
mean, it looks pretty unstoppable on paper.
Right. The S&P 500, the Nasdaq, the Dow Jones, they are all just repeatedly smashing all-time highs. So welcome to everything you need to know about finance.
Glad to be diving into this one with you.
Just a quick note before we jump in, this is not financial advice, just a deep dive on this data. And if you find this kind of content interesting, please like and subscribe.
Yes, please do. So our mission for you today is really to unpack the hidden forces driving these record numbers and, answer the biggest question on everyone's mind. Is it going to last?
Right, because under the hood, things aren't always what they seem. But let's start with the most visible driver, which is just this massive AI optimism.
Oh, yeah. The AI boom is doing a lot of the heavy lifting right now.
Yeah, investors are treating AI like, the next internet or the smartphone revolution. They are just pouring cash into a handful of tech giants.
Exactly. We're talking about NVIDIA, Apple, Microsoft, Amazon, and Meta. But there's a crucial mechanical secret here that a lot of people miss.
Oh, do tell.
Well, these major indexes, they're market cap weighted,
Okay, meaning what exactly?
meaning the S&P 500 isn't just, an equal split where every company has the same influence. A company's weight is based on its total market value.
Wait, so it's like a group project where two kids do all the work, but the whole team gets an A+.
That is exactly what it is. The headlines scream about record highs, but under the hood, a ton of smaller stocks are actually just flat.
So the tech giants are basically just dragging the average up.
Right. When a few massive companies surge, they pull the entire index up with them. It creates this highly concentrated rally.
That makes a lot of sense. So if we look past tech, what about the broader economy? Because, we had those aggressive rate hikes in 2022 and 2023.
We did, yeah. But despite all that, the U.S. managed what economists call a soft landing, which is incredibly rare.
Right, because unemployment actually stayed surprisingly low.
Exactly. And consumer spending remained really strong through all of it.
But the markets are forward-looking, right? I mean, they aren't just looking at today's rates.
Spot on. Investors are anticipating lower interest rates soon.
Which means cheaper borrowing. And I'd imagine a massive migration of money from bonds straight into stocks.
You nailed it. When bond yields drop, parked cash floods right back into the stock market looking for better returns. But there's another hidden layer here, the passive investing feedback loop.
Oh, you mean the automatic retirement contributions?
Yes, exactly.
Yeah.
Every single month, millions of people automatically route their retirement money into ETFs, funds like Vanguard or BlackRock.
And they don't even think about it. It just happens automatically on payday.
Right. And because those funds are market cap weighted like we talked about, that automatic money blindly buys the biggest companies.
Oh, wow. So it just blindly pushes their prices up further.
Which attracts even more money the next month, because now they make up an even larger percentage of the index.
That is a wild infinite loop. It just feeds itself.
It really does. The big just get bigger.
So for you listening, what happens next? Are we just going up forever?
Well, seeing all-time highs doesn't mean zero risk. Markets can be really expensive and, they're inherently volatile.
Right. There's always a chance for a pullback.
Exactly. But historically, if you look at the data, indexes actually spend a surprising amount of time near all-time highs.
Because corporate profits naturally grow over decades.
Exactly. Economies expand, populations grow, and the market naturally reflects that long-term growth.
That is fascinating. But I want to leave you with one final provocative thought to chew on before we go.
I love these. Lay it on me.
Don't forget about inflation, because stock prices are measured in dollars, right?
Right.
So when prices and revenues rise just due to inflation, stock valuations rise too.
Oh, that's a really great point.
Yeah, so it kind of begs the question, are these companies actually becoming more valuable, or is the money just worth less?
That really flips the whole record-breaking headline narrative on its head.
It definitely does. Definitely something to keep in mind. Thanks for joining us for this deep dive, and be sure to try out our latest episodes.